Equity Mates.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome back to another episode of Equity Mates, or should I say, hey there, champions. Welcome to this electrifying episode of Equity Mates. You are not just here to invest, you are here to master the game. Whether you're a rookie or a Warren Buffett, in the making, we are committed to smashing those barriers and catapulting you from your first investment straight to those life-changing dividends. If you're joining us for the first time, you're not just a listener, you are part of a community of achievers. As always, I'm joined by my equity buddy, Ren, and who am I?
Well, Bryce, when you spoke about mastering the game, I thought you were maybe Bryce Lesky in his second year at university reading the game.
Not true.
I'm going to guess you're Tony Robbins.
Yes, that is correct.
Wow, that was a toughie.
Yes, I reckon you've read my document. Sasha, we need to change.
I promise you I haven't. I was just trying to think like motivational speakers, you know, all of that stuff.
T. Robbins.
Yeah.
Yes. Well, if you are joining us for the first time, welcome to Equity Mates. This is a podcast where Ren and I track our journey of investing as we attempt to become better investors. And we have a massive show today. Before we jump in, though, a reminder that while we are licensed, we're not aware of your personal circumstances. So any information on this show is for entertainment and education purposes. Any advice is general. In today's show, we're going to continue the work we've been doing with our mentors. Ren's got a couple of stocks that he wants to pitch.
A few crackers.
We have a call coming up with an Equity Mates community member, Matt, about finding investment opportunities based on what's going on in the news. Love that. But to kick off, as always, news, portfolio changes. Let's do it, Ren.
Let's do it. Well, I mean, I'm looking at the Google Doc that we used to plan, and your first dot point is general market vibes. So I'm just going to open the floor to you here. What are you vibing?
I'm vibing that I reckon a month ago, there was a level of optimism.
Yep.
Now, level of pessimism.
Because inflation came in like a few basis points higher?
Yeah.
No, well, I don't think so, actually.
Well, no, I mean, like, core inflation is still falling here in Australia. But
so we got 5.2%.
Yeah.
Last month it was 4.9%.
Biggest driver is fuel and rent.
Yeah.
Yeah. So
feeling that. But they don't expect more interest rate rises.
Yeah. See, this is where I reckon that tune is changing.
You reckon?
Particularly over in the States, where there was a sense that the Fed were going to hold them where they are for longer. We had a meeting from the Federal Reserve last Wednesday where the rhetoric was that it's likely they're going to need to continue to raise to get it back into the band of 2 to 3%. Now, the Federal Reserve chairman has been pretty aggressive and has pretty much stuck to what he said he was going to do. And to be fair, America has the lowest rate of inflation of most developed countries in the world, so it's working. But more needs to happen to get to that point. And I think that feels to me at the moment that is changing the dynamic, and it's not as optimistic as it is as it was.
ASX 200's down 2% in the last month. You can certainly feel the... I guess it's like an uncertainty. When we spoke to Christopher Joy earlier this year, who's a big bear on housing, he's just a big bear generally. He was saying that the nightmare scenario that he thinks is more likely than most other people, and certainly he thinks more likely than the market thinks, is that we had that initial 12 interest rate rises in 13 months. There would be a holding period, and then there'd be another rate cycle. And that is where, like, you know, the mortgage cliff becomes really difficult and stuff like that. And from what you're saying there, I'm starting to get echoes of what Christopher told us 6 months ago.
Yeah, and his point as well was that additional rate cycle wasn't priced
Yeah,
in.
Exactly. Yeah.
So what we're seeing at the moment is reflective of the market thinking that rates are likely to hold more than they are, go up. And I think Chris's point was it's not just going to be another interest, it's another cycle of rises. So the thing I keep reminding myself as well is, you know, some of the leading economists say that the period that it takes for interest rates to seriously have an impact, the lag effect is like 12 months.
12,
I think I've said on the show, and that's like now. So it's buyer beware for me.
So here's my question. I'm going to assume when it comes to the stock market, well, at least I'm going to speak personally. I'm going to continue dollar cost averaging the same amount into the same core ETFs for my core portfolio. And then in my individual stocks, I'm just going to keep looking for value. Like long-term compounders trading at good prices. For me, like the interest rate story is probably going to be a story of more opportunity popping up in individual stocks, but it doesn't really change my behavior. You and I are both looking at buying a house. You're certainly further along on that journey than I am. Does it make you, for me, there's probably two things you would do. One is just wait and like see what happens, let the hiking cycle go, hope that prices fall. But the other thing would be you rush because it's like your 2 years fixed now before the next hiking cycle. If you think the hiking cycle is likely, how are you thinking?
Well, the third scenario there is that this is overblown and the interest rates don't increase beyond one. And then if what most people are thinking now is that next year we should start to see rate cuts in inverted commas, if that's the scenario, Australian property is just going to go on another rampage. So I think for me, the way that I feel comfortable about it, regardless of what scenario happens there, mainly if rates were to go up, is just ensuring that the way that we model it, you look at what it would mean if interest rates were at 8%.
Yeah.
And it's like...
I think for me, the biggest thing is that 1 month is not a good enough data set. So 4.9% inflation came in last month and everyone was like, have we engineered a soft landing? Are we on a glide path down back to 3? Are we going to see this? Are the interest rate settings that we're at now the right ones to get us to where we need to go in a medium term? And then you get 1 month where it goes up 3 basis points. Like that's a rounding error. That's like not a meaningful statistical variation. You go from 4.9 to 5.2 and all of a sudden the market's down 2%. Everyone's freaking out. You're talking about an interest rate hiking cycle and people change behavior on the back of that. 1 month is not enough data to make decisions. Because if it comes in at 4.6 next month, are we back to like... everything's going well, let's rip?
Well, I think a lot of it's being led by the US. And I think more importantly, what the RBA look at is core inflation, and it didn't go up. It was headline, which, because they exclude things like petrol and rent, which is a bit ridiculous.
Which aren't core to anyone's living
Exactly.
expenses.
It's a bit ridiculous, but core inflation, excluding the two largest contributors to it, is continuing on a downward trend. So, yeah. TBC, watch this space.
So we mentioned there that regardless of what happens next, dollar cost averaging for your core portfolio is the name of the game.
Yeah.
You sent a chart around to the Equity Mates team of your dollar cost averaging points in recent weeks.
Yeah, I just looked at it out of interest and I was spewing.
Well, tell us.
So my dollar... I use Superhero and
not sponsored.
Not sponsored. And you can... I'm sure most brokers do it now, but you can see... on the chart for your stock where every buy point you make and even sell. And so you can see your dollar cost average play out. And just by nature of how I've set it, every point that I've missed in the last sort of 3 months or so, I've missed any drop in the market.
And when you say because of how you've set it, it's not like, it's just like pure
coincidence. Pure coincidence. But because I was looking at it, it's like my average price and where it is now, I'm just like, that doesn't really make a lot of sense. It's because every time I've bought, it has essentially been the same price because I've missed any sort of absolute peak. I've missed any sort of absolute drop, but I've tended to be on the higher side of the average.
Yeah, okay.
And I'm like, damn it.
Yeah.
But there's literally nothing you can do about it. And the data set was super small. I think it was only 3 or 4 transactions. If you obviously take it out to 5 years or whatever, it's different. But
well, you expect the asset to trend up over time.
Yes. Yeah. So I was looking at it at a point where it was down, and so I thought I'm gonna just put a bit more in here myself just to try and get my average price down a bit.
Nice.
I thought that was interesting. Anyway.
So one thing that I was reading this morning, there's heaps of stock chat coming up, but I'm just going to slip one more piece of property stuff in there because I think it is relevant for the broader economic story. And a lot of the stocks that we own are going to be very affected by the wealth effect of the housing market. We even saw it with retailers in this earnings season come out and say they're seeing reduction in spend as people tighten their belts and allocate more to their mortgage. We're halfway through the mortgage cliff. We've reached the halfway point.
Yay.
More than half of Australians who had fixed rate mortgages that were rolling to variable have done that, according to ratecity.com.au. More than 1.3 million fixed rate mortgages have expired either last year or this year, and they were saying that is the halfway point. So I feel like now is the time that we start to feel the effects.
Yeah, on this point, similar to the lag of interest rates, economists believe that the lag effect of your increase in interest rate going from 1% to 5% for households is about 6 months. People don't just have it flick over and then all of a sudden, whilst they might be in stress, it takes a while for the action to be made to either sell or reduce spending or whatever it may be.
Well, CoreLogic have looked at, so if people flick over to variable rates, can't afford the mortgage, sell the property. That's kind of, so CoreLogic have looked at short-term sales. They've found that houses that have been resold within 2 years of purchase have risen slightly to 8.5%. But in August, short-term sales within 3 years reached a record high from their data of 16%. And interestingly, within that, the number of loss-making short-term resales, so when you sell it for less than you bought it for, has gone up from 2.7% this time last year to 9.7% in the June quarter.
Sorry, short-term being like rentals?
No, short-term sales. So buying it and selling it in less than 3 years has gone up to 16%. And the percentage of those that were then sold in that short-term window at a loss has gone from 2.7% to 9.7%. Yeah.
I was talking to someone the other day, I'm not going to mention, but they bought an apartment in the middle of Darlinghurst. You would think Darlinghurst, safest houses, and bought it 6 years ago. So would have ridden the interest rate rise, but also the boom in house prices. Went to sell it this year. We're getting offered $100K less than they bought it for. So it's like far out.
Yeah, not surprising.
Yeah.
All right, Bryce. Well, I think that's enough property chat. Let's get into the stocks. We got contacted by a listener from Canberra, Matt, who wanted to talk about building investment ideas and theses off what's happening in the world and in the news. So let's give him a call and unpack this.
Hello, Matt speaking.
Matt, it's Bryce from Equity Mates. How are you going?
Good, thanks, Bryce. How are you?
I am well. I've got Ren here as well.
Hey, Matt. How's it going?
Yeah, good, thanks, Ren. How you going?
Yeah, good. Well, before we get into it, tell us a bit about yourself. You're from Canberra. Love that. What's your story?
So I'm from Canberra. I look, a couple of years ago, hated discussing finance and anything talking money and all that sort of stuff, and then got onto the FIRE movement from one of my mates, and that kind of got me interested in investing and that sort of thing, and then came across your podcast and kind of been listening ever since. Yeah, and my question kind of came from where I started and not really knowing anything about financials and how to look at what rates of return and that sort of thing were, but more just thinking about scenarios and where there would be opportunities and that sort of thing. So yeah, that was kind of where I started looking and started my investing journey, and here I am. So my question is, looking at some upcoming events, I know that was announced recently that Australia is about to go through an El Nino summer. So looking at hotter temperatures and that sort of thing, and the potential for, more bushfires and that sort of extreme weather scenarios. So thinking about that sort of stuff, is there opportunity there that people should be looking at, or things that are going to affect the market, I guess, over the next 6 to 12 months?
Love it. We were talking about this in the office yesterday. I think before we get into our thoughts, have you developed your thinking beyond the question, and have you thought about what opportunities might exist or how you would actually tackle this, because it's not something that just applies to El Nino. It's something that anyone sitting at home watching the news or reading the paper, like this is a classic way of finding investment opportunities using what's going on around you. Have you thought about the next part of this?
Not too deeply at the moment. I guess it's sort of triggered for me. I know you guys in the past have talked about, insurance companies and whether or not they're good investments at particular times, or I know they go through cycles, but if we know we're about to have like an extreme scenario, then is that going to disrupt what their normal cycle would be? Or then looking at, go back to COVID for an example, it was kind of a once in a lifetime scenario, but then we saw how that kind of played out with Woolies and Coles and what that did to their share prices, because they suddenly became, really important things within everybody's COVID experience. So trying to apply that kind of a lens, I guess, to going through an extreme weather scenario.
So we've got a few different ideas, but the insurance one is interesting because my initial thought was insurance wouldn't do well in El Nino. And, you think about the 2019 bushfires. I pulled some numbers. Insurance Australia Group had a $400 million bill for the December half at the back end of 2019. Suncorp, about 300 to 400 mil. So I was thinking it'd be tough being an insurer with, higher risk of bushfires. But then Bryce found some data that challenged that. Yeah,
it's interesting. It's the reverse in a situation for El Nino when you're getting these hotter periods. Because apparently a lot more people are more prepared for bushfires than if a cyclone rips through or flooding.
Probably more you can
can prepare. Well. Yeah. And so the result of that is actually Morgan Stanley did some research to find that only 11% of total Australian catastrophe claims since 1968 have been related to bushfires, compared to almost 60% from cyclones, storms and flooding. So much fewer claims in times of El Nino.
I think their research had 40% fewer catastrophe claims on average in El Nino years compared to La Nina. Surprisingly, but also not surprising when you think about it, motor accident claims are also reduced in El Nino conditions.
You're not sliding around everywhere.
Yeah, because it's drier. So that was
maybe you're long insurers.
Well, I think Morgan Stanley's pick was Suncorp Group.
There you go.
Given its better budget placement and greater exposure to Queensland. Because Queensland gets hit quite hard by cyclones and flooding in La Nina.
Yeah.
So there you go. That's one that I initially thought and then flipped it around. But I guess let's take a step back, throw some ideas out there. El Nino, it's hotter, it's drier, there's bushfires. I am a very pasty man. So my first thought was, I'm going to need to lather myself up in sunscreen.
Mate, that's just summer for you.
Honestly, that's winter as well. So I had a look at who are the big sunscreen makers in Australia. There's one company that does a lot, Baxter Laboratories, not listed. There is a Baxter that's listed over in the US, but I don't think they're related. But Baxter makes Cancer Council sunscreen. They make Woolies brand sunscreen. They make heaps more. So unfortunately, you can't invest in it, but that's a little nugget of information.
Nice.
But what about if maybe not the supplier, but the looking at the pharmacist? Is it I can't remember the name of it now, but isn't there a pharmacy group that's
like Chemist Warehouse or API?
Yeah. Priceline.
Yeah.
But yeah, that's a good one. Getting the retailer who's selling these products that are, I guess, going to be an increased demand. I think the challenge with those is you're naturally going to see an increase in demand across summer anyway. So you're trying to find that, I guess, that delta of what's going to be above and beyond.
I think it's is it material? You know, like people are going to be buying, more sunscreen from Coles and Woolies and more bottled water and stuff like that, more Zupa Dupas and ice blocks. But if you're talking about a $20 billion business like Coles or whatever Woolies is at these days, it probably doesn't really materially make a difference. There are other parts of the market where it will make a difference. That would be my thoughts.
I think speaking of material, I think the big one you can't go past is thinking about agriculture.
Yeah.
So there are a couple of ways to look at it. You can be looking at companies that supply irrigation, water rights, which we'll get to in a moment. But I think one that I found interesting, I don't have a stock for it, but is drought-resistant seed. Speaking to Dad about this overnight, and when drought can get particularly bad, it can have a pretty significant impact on your ability to grow crop. And so there are companies out there that have, I guess, GMO'd or have particular seed that is survives well and in drought conditions. So in a situation where it's drier for longer, it's companies like that kind of might present an opportunity. And then water as well. Water scarcity, I think, just generally when you're not getting a lot of rainfall is a big opportunity. And there's a company listed called Duxton Water. The ticker is DTO. It's the only company...
No, D2O.
D2O, sorry.
Unbelievable that they couldn't get H2O.
I know. It's the only company listed on the ASX that provides investors with direct exposure to Australian water reserves.
Yeah, so I guess they own water rights.
Yeah.
And then, yeah.
So is this sparking any inspiration for you, Matt?
Yeah, I think so. I think looking where I guess the impact isn't necessarily immediately obvious, because I think, like you said, going back to talking about, Woolies and Coles, and everybody knows summer is hot, so that's probably already factored into the price. So yeah, so looking at where that surprise impact is, I guess.
So here's a couple of other ones just to get you thinking, and then I've got a concluding thought on everything that we've thrown out here.
Yep.
The last El Nino cycle with the bushfires in 2019, Costa Group and Vital Harvest, two of the big agricultural players, they did poorly. Bushfires ripped through a lot of their crops. More died because of drought. So those two companies didn't do well then. Elders is another agricultural company that benefits from livestock sales, and so 2019 was not a good year for them because of in livestock sales as well. So there's some agricultural plays. For me, as I was thinking about it though, I was like, yeah, but a lot of these companies would also get affected. Livestock, not so much, but crops would get affected in storm seasons as well. So like, that's just the nature of agriculture. It's brutally tough. And so maybe, again, it's like, how material would it be? Like, how much would it change everything? And what we lived through in 2019 probably, or maybe not the same in 2023, hopefully not the same in 2023, but they're ones to look at. And then one other one, Super Retail Group is it owns BCF, Boating, Camping, Fishing. It owns Rebel. Maybe if there's less rain, it's hotter, there'll be more outdoor activities, so those companies will do well.
Yeah.
Material.
Unless there's heaps of fires, then those companies probably won't do well because
masks.
People will stay inside. But that's another one to think about.
Yeah.
And then finally, one company that I've come across recently that we're actually going to speak about a little bit more later in this episode. There's a company that specializes in rebuilding for insurance companies. So like if, like a house or a town is destroyed in a disaster, they get called to rebuild. It's called John Lyng Group, Lyng. They make 90% of their money from insurance contracts and like disaster recovery and stuff like that. So that's one that I'd never heard of, but it's an interesting one.
Nice. My concluding thought is watch out for, it was in the same article that the Morgan Stanley stuff on insurers is watch out for inflation as well, particularly through food. If no one can grow avocados, those avocados are going to go up in price and input costs into a lot of the food that we eat. So a watch on inflation.
My concluding thought is just like, be careful about being too short term with all of this. Like everything we've spoken about here, like it's fun to think about, and I think it's a good exercise to think about like the first order and then the second order effects of change. Like that's it's a good investing muscle to build. But El Nino will pass, and like if you've invested in a bad company because you think that like the weather conditions will help it, the weather conditions will change and then you're just stuck with a bad company. So it's like, make sure you're confident in the company as well.
Yeah, I definitely agree with that. And I think, like I said, it's looking at a kind of a short-term something that's going to disrupt how people would normally behave or disrupt how the market would normally behave. But obviously being aware that ultimately, mostly things will come back to normal. So not banking on it for too long or too much, and being confident in what you pick.
I mean, the flip side is there might be companies that get hurt in this short-term cycle because of the climate conditions that then offer a very attractive price and you say, hey, they're not doing well right now, but the weather will change and this is a great company, and so it might be an attractive entry point.
Yeah.
But that's a whole other conversation.
Whole nother conversation.
Yeah.
Now, Matt, to close, I've been briefed by our producer, Sasha, that you're, well, firstly from Canberra, but you're also a Raiders fan, and you've had a crack at me for not knowing that the NRL clubs have songs. So to close out, would you mind singing me the Raiders song?
Look, I got to be honest. It's actually my partner. She's the massive Raiders fan,
Okay.
and our new son. So shout out to Josie and Will.
Nice.
But yeah, no, I think you just have to look it up. It's a banger.
Matt, we're about to take a break, and let's go out to break with the Canberra Raiders theme song.
I love it.
Sounds good. Thanks, guys.
Nice. Thanks, Matt.
Thanks, Matt. Really appreciate your time.
Don't try and stop these men in green, 'cause we'll hit ya, and you'll see green.
Welcome back to Equity Mates Investing Podcast. We've just had a conversation with Matt, and I now know 2 NRL songs, Ren. We've had the Panthers, we've had the Raiders.
The Raiders. 16,
Far out. I need to bring in a bit of...
15 to go.
15 to go. I need to bring in some AFL songs here. I think they're a little bit better. But anyway, the final segment for today's show is a continuation of the work we've been doing with our mentors. Andrew Page is your mentor from strawman.com, and I'm working with Henry Jennings from Marcus Today. I actually haven't checked in with Henry for a while.
He's on the longest European jaunt.
No. I was overseas for 5 weeks, and then Henry went overseas. So we haven't touched base for almost 10 weeks now, so I'm really looking forward to him being back on home soil so we can pick up our conversation to close out the year. But Ren, you've been working in the background trying to find or continue to find those high quality companies that both you and Andrew, well, I mean, many investors love to find.
I mean, it's the name of the game.
Yes.
I mean, once upon a time, you loved to find them as well.
Yeah. So we spoke about ResMed last week, and we got great feedback from many of the community who agree with the thesis.
Yeah, it feels like it's almost a consensus pick among Australian fund managers at this point.
Yeah, too good of an opportunity.
Its price keeps falling. So it's like, is Australia wrong as a country?
What do you mean?
Well, it's like, it feels like a lot of the selling, I mean, there'll definitely be people in Australia that don't believe in it, but it feels like globally, like Americans and Europeans are a lot more negative about ResMed, a lot more positive about Novo Nordisk. And it's like Australians, maybe because we're parochial or...
Well, it's up 10% the last 5 days, so you can't complain with that.
Equity mates bump.
So, Ren, that brings us to today. You've been working in the background you've got 3 companies that you want to talk about.
Yeah. Now, I haven't bought any of these yet, but I might buy some of them. But 3 interesting companies that I'd never heard of before that I just wanted to bring to your attention, have a chat about, because this is what I love. And this is why I love investing. And I'm glad that I've been working with Andrew and that we're sort of making time to do this, is just like finding companies working on interesting things that I just hadn't heard of before. So I've got 3 companies. This wasn't deliberate, but they're orders of magnitude different in size. I've got a $2 billion company, a $200 million company, and a $15 million company.
Nice.
You choose. Which do we want to start with?
Well, firstly, I think the question will be, how did you find them?
Just broad reading, as annoyingly vague as that answer is. But I just have a notes app on my phone where if I come across an interesting company, I write it down. It's like my to research list. And just from podcasts I listen to, things I read. I mean, like, we're in a privileged position where all we do all day is investing content. And, we speak to experts on the show, and then we make content for social media and emails. Sign up to our emails, by the way.
equitymates.com/email.
Yeah, I just have a list and I just work through it.
Nice. So there's no initial stage of using stock screeners or anything like that. Yeah. This is just from reading, which we hear from a lot of experts. All right. Well, let's start at the top. Let's go biggest to smallest.
Okay, biggest. So when we just spoke to Matt about El Nino and finding companies, I mentioned this company, John Ling Group, ASX ticker JLG. It's a little bit grim. So this company makes its money from rebuilding after disasters.
Okay.
Or not just disasters, but like it works with all the big insurers. Like it's rebuilding and recovery. I'll just read how it describes itself. Provides building and restoration services for insured properties and communities impacted by extreme weather events in Australia. So the insurance, building and restoration services business is 90% of its revenue. Then it's got another smaller business, which is just commercial building and construction, which is 10% of its revenue. It operates under 24 different brands. So they may have rebuilt a house near you, your house, without you even knowing it. The financial story is really interesting. So in 5 years, it's gone from $287 million in revenue to $1.2 billion in revenue. Last year's revenue grew by 43% and net profit jumped by a bit more than 60% to reach $62.8 million. It trades on an okay multiple, so it's 36 price to earnings, but it's growing really quickly. Part of the reason why it's not super expensive is because the company has said that this year is going to be tough. Revenue is actually going to go backwards this year. It's going to go from 1.22 billion to 1.14 billion. And that's because its commercial construction business is in a world of hurt. It's going from $370 million in revenue to $140 million in revenue. So what's that?
Why?
Don't know.
Fair enough.
I need to do more research if I was going to buy it.
Slow down.
This is just like high level what I've found so far.
Yeah.
But the insurance restoration business continues to grow quickly. It's expected to go from $850 million to $1 billion in revenue. So two very different stories of the two underlying businesses. But here's the thing, Bryce. Here's where it gets interesting. The commercial construction business isn't profitable. It lost $19 million last year. The rest of the business made $138.4 million in EBITDA. But then because the $19 million gets wiped off that by this unprofitable business unit, the final EBITDA was $119 million. So reducing the size of the commercial construction business, reducing the revenue there, will actually improve the company's profit because they're making less of a loss.
Yes.
And so even though revenue is going to go backwards this year, that's what the company's forecast, they think profit will go up from 119 to 128. And so that's an interesting business. That's an interesting story if it's just like we're cutting our losers, we're going to take the revenue hit, but we're going to be more profitable. Yeah.
What's the long-term thesis for this though? Like,
more climate change.
Yeah, it's
more
climate
disasters.
change. You're betting on the fact that more and more people are going to suffer from catastrophic weather events.
The thesis would be something along the lines of these guys have entrenched relationships with all these massive insurers.
Yeah.
It's hard to disrupt that because insurers don't want to be dealing with lots of smaller providers in different localities. All these insurers are national players, and so they want to be dealing with a national restoration partner. So someone would have to have meaningful scale to then challenge for their contracts. There would be other players out there. And then top line, the amount of work is going to grow because the world has been slow to deal with climate change. And there's just generally like a bigger population. And this isn't just like climate related disasters. This is also just like day-to-day insurance stuff. You know?
Yeah.
Houses burn down or flood and stuff like that.
It's not just you've been wiped out by a flood.
Yeah. And so then you make a claim to your insurance company and then they call these guys and they fix it. Yeah. Or it hails and you get, your window repaired and stuff like that. That's a company that I hadn't heard of before. Profitable, growing, meaningful double digits, few little internal tweaks in its business that are interesting. So that's one that I thought I'd bring to the table.
Nice. All right. So that one was Johns Lyng Group, ASX ticker JLG. Moving down the market cap size, we've got 200 million market cap coming up next. What have we got?
Yeah. LGI Limited, ticker LGI.
Yes.
So I had some work in the waste industry. Well, I worked for Coles, but was exposed to the waste industry, and I find it fascinating. There's money in landfills, I'll tell you what. This company is making landfills greener.
Planting grass.
No. So founded in 2009. Take a step back. Landfills when like organic matter, food waste, stuff like that breaks down in landfill, releases methane.
Yeah.
Traditionally, that just went into the atmosphere.
Yep.
Not
Greenhouse
great.
gases.
Now there are companies like LGI that are working to capture that biogas, and now they can also flare it, less emissions.
Yeah.
Or they can convert it to energy.
Okay.
Yeah. So that's what LGI does. They have solutions that, range from biogas capture with ERF, Emissions Reduction Fund compliant flares, to the conversion of biogas to renewable power. And then they also use synergistic technologies, accompanying technologies like batteries and alternative energy offtake agreements to store the energy or divert it elsewhere. But essentially what they're trying to do is use and monetize the gas being created by landfills. They currently have 26 sites, 8 biogas to energy or biogas to power, 17 where they flare it.
Burn it.
Yeah, but you get Emissions Reduction Fund money because it's not being released into the atmosphere. So there's a better environment.
So where do they burn it? How do they burn it?
I don't know, just get a lighter and...
So some other gas is released into the atmosphere, or like, do you know what I mean? Like,
yeah, you're gonna have to. I'm just telling you what I
level.
know at this stage, all right? And then they've got a few other facilities, a number of them creating carbon credits, and then also selling the energy. 200 mil market cap. The founder is still the CEO.
nice.
Love to see that.
Yes.
But here's what I found interesting. So they've got 26 sites so far. The company predicts, so there's 1,100 operational landfills in Australia, 1,100. Of those, they reckon a little over 200 may be suitable for their biogas solutions.
Okay.
So they sort of see an opportunity to expand meaningfully. And, for a landfill operator, if they're just releasing the gas and they're not monetizing it in any way, then it's a simple question of like, what's the capital cost to implement LGI? What's the ongoing operational cost, and how much money do we make back? And if those numbers stack, then it's you're monetizing something that isn't currently monetized.
Yeah.
So FY23 results for LGI. Revenue up 27% to 30 mil and profit up 35% to 6.5 mil. Having a look at their different revenue lines, all of them grew. So the money they made from energy generation up 42%. The renewable large-scale generation certificates that they earn money from up 4%. ACCUs, which are the carbon credits, up 14%, the revenue from that. And then their infrastructure construction and site management costs up 55%. So all their revenue lines are growing, which you like to see.
Yeah.
But I think it's just an interesting one. Like, as much as we all want alternative solutions for waste, the fact of the matter is
far off.
Waste to energy facilities, which are big in Europe, are being built here, but they're expensive and they're not going to be a massive solution. And Australians suck at recycling.
Yes. Well,
Like, we genuinely suck at it.
yeah.
And so that's going to be a handbrake on closing these landfills down.
Yeah.
So the fact of the matter is they're here, and companies like LGI are trying to make them greener. So it's an interesting one that I didn't know about.
Love it. 2 climate change thematic stocks here.
Yep.
Long-term climate. To close out, we've got the smallest of the 3 with a market cap of only $14 million.
14 mil.
What do we got?
So this one, shout out to Andrew, my mentor, who interviewed the CEO of this company at Strawman. So for Strawman members, they probably have heard of this company. It's called Beam Communications, BCC. Yeah, that was a knowing. Have you
I've
heard
heard of them, yeah.
Really?
Yeah, I don't know how.
Are you a member at Strawman?
No,
Yeah.
I was until it's paid service.
Yeah, it's private. You can only sign up like once every 6 months.
Yeah. Anyway,
Yeah.
Beam.
$14 million company, microcap, tiny. $11 million in revenue in 2018, $40 million revenue last financial year.
Wow, with a 14 million market cap.
Yeah, so good growth. So it grew about 60% its revenue this year. The company has forecast a similar growth rate this year, so growing pretty quickly. It's profitable. $2 million profit.
Love it.
Which means its price to earnings is 7.
What does it do?
Great question. No, it does like satellite communications. So I think it's got some device that if you're like you're on a boat in the middle of the ocean, you can call for help. Yeah. And I think that's why it's sold off. So like why its price to earnings is so small, because everyone's like, aren't Starlink just going to come and eat your lunch?
On that point, I watch a lot of boat videos on YouTube, people sailing.
Yeah, of course you do.
Super yachts, and also just people doing the solo travel around the world. A lot of them are talking up Starlink.
Oh, really?
They love it. So a lot of the super yachts, when they would do the Trans-Pacific, it's a 2.5 week journey, and in the middle of the Pacific, you obviously usually would have no reception for internet, and they've all plugged in Starlink now and
wow.
raving about it. Yeah.
So to build on that, Alice's parents, my partner's parents, they live in Forbes on a farm. They have Starlink, and same thing. They're just like, they say it's epic.
I think Flynn's parents do as well in Barrel.
In Barrel, yeah. And then I've been to a couple of rural weddings, and Starlink has come up, and everyone's like, it's epic. Yeah. So, yeah.
Starlink is a song, isn't it? Anyway.
Is that related?
Well, every time someone says Starlink, I have this song go in my head, and I'm just thinking it's probably, knowing my luck, it's just probably the completely wrong song.
Starships, you mean?
No, not Starships.
There is, I've Googled Starlink song, and there's at least 6 songs.
Yeah, I've done the same. None of those ring a bell, but...
Star Walking by Lil Nas X.
I don't listen to that stuff.
Anyway, so let's get back to Beam. So they create, I guess, like satellite phones. It's probably, and they've got some other devices, but yeah, they're a satellite communication company. So, rural mine sites and stuff like that. But these days, a rural mine site would be hooked up to the internet with Starlink or something else. So I think the way that we're speaking about this company and the threat from satellite internet players, because it's not just Starlink. There was that big British satellite company OneWeb and the French one Eutelsat merged as like they wanted to create a company that would rival Starlink, and they've both got one of them was geostationary, so big satellites further in orbit, and then the other was doing low Earth orbit satellites, which is what Starlink do. So satellite internet is going to become more and more of a thing, and it's going to be more and more of a threat for a company like Beam Communications. But if it's profitable, if it's growing, and if it's trading at a 7 PE, like at some point, every company becomes worth buying.
Yeah.
And I'm not sure if this is it. Well, even if I was sure, we wouldn't be giving advice. But it's an interesting one, just purely from the financial story, I think.
Yeah, super interesting. 14 million microcap. Okay, year to date, down 26%. It doesn't actually have a lot of movement.
Well, yeah, it's a $14 million
small. Yeah, PE of 7. Nice, Ren. So just to recap there, all of these companies have just come through broad reading that you do throughout the week, and you create your own watch list, I guess. And this is the highest level of research that you'll do before actually then
the highest level
generating
being like a high level, not highest level as in like the most advanced.
Well, that's what I mean.
Yeah.
It's high level, getting
like
an understanding.
First pass.
Yeah, exactly.
Like, what does
first
the company
pass.
do?
Are they profitable?
Are the numbers interesting?
Yeah,
Is it worth exploring? Is it growing? Because what I want to do, what I'm working on with Andrew, and what I'm sort of, I guess, doing in my own time as well, and I think what a lot of people are trying to do is just find really interesting companies that have a long growth potential ahead of them, like and then are managed by good teams that will realize that growth. Like at its core, that's what investing is all about. Strip back the numbers and the jargon and the data and the charts, and all we're trying to do is find great businesses and then, like a leech, attach ourselves to them and join them for the ride.
Interesting to note they're all Australian companies, either home country bias or just you're reading a lot of Australian literature.
Actually, I'm trying to find companies to talk to Andrew about, and he's pretty Aussie focused.
Makes sense.
And
fair call.
He made the point when we first spoke that there's so much opportunity in Australia. Like there's thousands of listed companies in Australia that you don't know and that are doing really interesting things. So it's like until you
exhaust that.
Yeah. And you know, you have an informational advantage because you're in the market where most of them operate.
Yeah. Nice. Well, I'm looking forward to getting Henry back in the studio. Stay tuned. He should be landing in Australia any moment. But that brings us to the end of today's episode. Thank you for joining, as always. And if you've just joined us for the first time, welcome. I hope you enjoyed that episode. We should mention that we have an Equity Mates newsletter that goes out twice a week. You can sign up at equitymates.com/email. And also you'll find in the show notes today a quick listener survey. We're trying to get your opinion on what we can do better, what you really enjoy about the show, so that we can start planning 2024 to be even bigger and better than 2023 with the direction of the show into next year. Ren, as always, it's great to chat stocks. We'll pick it up next week.
Sounds good.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.